coffee. Welcome to the Rural Classroom Plus. This is Steve Barton, and thank you for tuning in. Today, we will be taking your questions and asking Rick himself. If you're watching on YouTube, Twitter, or any other outlet, we'll be pulling the questions from the Rural Classroom Plus. So head over there using the links down below, or go to ruralclassroom.com. You can try out the classroom for my favorite price. It's free. And for more serious investors, join us in the Rural Classroom Plus. You can try that one out free for 2 months with no obligation, cancel, and you owe nothing. We would love to have you. Rick, how are you, sir?
I'm doing very well, Steve. Thank you. The better for being on with you and my friends in the classroom. Particularly interesting time, I think. The volatility that we've seen in the market always teaches us lessons. And I'd like to begin with some reflections on those lessons. I've learned over 50 years of investing myself and counseling other investors that for many people, well, let's begin with a famous Warren Buffett quote. He says, Wall Street is the only store where consumers like items less when they become cheaper. And I think we've seen that. People get wedded to some narrative in their mind, and when the price goes down, and therefore the opportunity becomes less expensive, the fact that the price went down causes them to question in their own mind the value of their narrative. Similarly, when they have an idea and the facts haven't changed, but the price goes up, in other words, the idea is more expensive, they like it more. It's odd. I used to give this parable in my speeches about a woman going to a grocery store while her husband went to the stock brokerage firm. And she went and she found the tuna fish that was selling for $2 a pound, which she felt to be a reasonable price. And so, she bought a case of it or however much. And he went to the stock brokerage and found a stock that he thought was attractive. He'd read about it in some newsletter for $2. Thought that was a reasonable price. So he bought himself 1,000 shares, and they both went home relatively happy with their purchase. They came back 2 weeks later. She went to the store again, and she found the same tuna fish selling for $4 a can, which had previously been $2 a can. And she was outraged. She, read the riot act to the store manager and bought herself a couple of cans of, canned chicken or something instead. The husband, by contrast, went to the stock brokerage house and found the same share of stock with nothing changing in the fundamentals for $4 a share. And he was elated, bought himself another 1,000 shares. They both went home, her distressed, him elated, came back 2 weeks later. When she went into the grocery store, she found that other housewives had been as scandalized as she had. And the store was lousy with tuna fish. Nobody was buying it, and it had been marked off to $1 a can. She was ecstatic. She bought so much tuna fish that her car rode with the trunk down, The husband walked into the brokerage firm and found that this same stock, which had been $2 and then $4, was now $1. Nothing had changed with the company. He was disgusted. Sold his $2 stock and his $4 stock. Who reacted more rationally? The woman buying the tuna fish or the husband buying the stock? And I think that's the lesson that volatility teaches you. The set of circumstances that we've been talking about in the rule classroom, which is to say, among other things, that tariffs are taxes and that taxes are bad, that really true free trade is good, and resource nationalism is bad, all those things are bad, and that the only thing we could really count on the markets was turmoil, is coming to pass. We have described volatility as a series of sales. And we've described the process where you have to understand something about the value of the assets that you seek to buy or sell before price has any interest. So it's important that we learn all those lessons. If you have done the work to understand something, and by the way, you're never going to get it right, of the value of the investments that you make, you can put the price in context. The fact that something's $1 a share or $2 a share or $4 a share, if you don't have any underlying opinions to its value, becomes irrelevant information. But the price information is what we feel like we can spend, and it's also the information that's the easiest to obtain. So we value it highly. I've been monitoring a bit of social media. And one of the things I notice as an example is in the discussions of uranium. People say, what's changed with the narrative? Well, the precise answer is almost nothing has changed with the narrative. The spot price has declined a bit, or at least stagnated. And I guess there were some people who thought that because uranium had gone to 70 or 80, it was going to go to 200. And maybe those people are discouraged. But the set of circumstances around why that price rise over time might happen are completely unchanged. And yet the stocks are off 50%, 60%, 70%. People who had uranium as part of their X handle have now left the uranium market in drag. It's interesting that while nothing in the narrative has changed, the fact that you can buy the narrative for 50 or 60% less than you could have bought it for a year ago is somehow unattractive. I'm not saying this to make a stock recommendation. I'm saying this so that people can understand the speculative process. If you've done the work on valuation, bear markets are sales. Volatility is simply a series of small sales, if you will, on echelon. Now, let's look at some of the underlying causes of the volatility and think about how that might be good for us or bad for us. We've seen that most of the volatility in the markets has been downside volatility, which for some reason bothers people more than upside volatility. I'm not sure why that is, but the fact is that it is. A couple observations here. the bond market got absolutely clobbered.
Yeah.
And probably, I would suggest, as a consequence of the bond market getting clobbered, President Trump backed off on most of his tariff packages. This is instructive for a whole bunch of reasons. Instructive because this kind of government meddling, whether done by the right or done by the left, is bad for markets. It raises the cost of capital. That's the first thing. Second thing is maybe a little more profound. It may be that the government is losing control of the interest rate cycle, losing control of the bond market. We saw a hint of this 6 months ago, where the government was trying to force or jawbone short-term rates down, which they succeeded. But despite that, long-term rates rose. You will remember that former President Clinton said that after he died, he wanted to come back as the bond market because it was all powerful. Mr. Clinton, you may recall, if your memory goes back that far, was forced to cancel his government spending, his stimulus package, because of the, quote, bond vigilantes. The bond vigilantes were punched into obscurity by the Fed and the Congress, but it would appear that they have begun to reassert themselves. The fact that the bond market itself, or the market itself, is beginning to take control of interest rates is something that we all need to consider. That may mean that the Greenspan put has vanished. Does it definitely mean that? No, but it's definitely something that we need to consider. As resource investors, we need to consider something else too. We need to think about the fact that for at least the last 50 years, the government's response, even to volatility, the government's response to the appearance of panic in financial markets has always been, to the extent that they can, to artificially lower interest rates and to raise liquidity. What commodity is a beneficiary of artificially low interest rates and increased printing or liquidity? I would argue for you that the commodity that's the primary beneficiary of the most likely policy response to the turmoil and the circumstance that we're in is gold. I noticed too that for the first time in a long time, foreign currencies are perking up relative to gold. Am I suggesting you abandon the dollar and think about foreign currencies? No, I'm not. But I am suggesting that you consider diversifying your cash savings into currencies, including a basket of currencies, not in the dollar. Is this a certainty to work? Of course not. There are no certainties in life. Life is a series of probabilities. And the truth is, you're going to make mistakes on occasion. You're going to get things right on occasion. But the more that you apply yourself rationally to the task at hand, the more you think through the circumstances as opposed to feel over the time, the better that you will perform. I've been posting over the last weekend and into this week with the headline Panic or Pounce, trying to ask speculators to consider what is the most profitable response to the circumstance that they see themselves in. It's important for you too to think about the circumstance, think about your needs, think about your risk tolerance, think about your time preference, and think about, in circumstances like this, do you get shaken out? Or as a consequence of lower prices for assets that you like, do you come in? That's really all I wanted to talk about. Oh, one more thing, actually. It's interesting how people respond to stimulus. Many of you know, pardon the blatant commercial, but many of you know that Battle Bank, after a long gestation period, is probably ready to become functional. Rather than trying to become a de novo bank, which is something that we used to do, we are buying a small bank and changing its business plan. I had an interesting conversation on social media with a person who looked at the circumstance around him, and he asked me, why on earth would you be starting a bank now? The existing banks have balance sheets that are full of commercial mortgages that are going to blow up. There's all these weird economic circumstances. The banking industry is chaos. There's disintermediation in the deposit products. Why on earth would you start a bank when there's so much problem in banking? The answer to that, of course, is that the problem in banking is precisely why we're starting a bank. The fact that all of our competitors, virtually all of our competitors, will have wounded balance sheets. The fact that increasingly depositors are uncomfortable with their current institutions. The fact that all of our competitors will be playing defense when we're allowed to be playing offense is precisely why we're starting a bank right now. In fact, I ought to probably praise the legislators, praise the regulators for keeping me from being able to start a bank 18 months ago or 2 years from now, and saving our salvo into the banking business for a wonderful period of crisis where we can strike hard while our competitors are in fetal position in the corner, licking their wounds. I say this not merely as a commercial for Battle Bank, but really to ask people to adjust the way that they think about the circumstance. Like the famous old Doug Casey newsletter, crisis is opportunity. And by the way, we're not in a crisis yet. Hang on. It's going to get better or worse, depending on your point of view. So, Steve, that's the rant.
Okay, let me see if I could summarize this here pretty quick. So I got to say as well, this was the most fun I've had since C19, since the pervasive sickness, and there was just a washout. The last 5 days have been a lot of fun for me. So basically, treat these equities like you would treat tuna fish. If it's on sale, buy it. If it's expensive, sell it. You noticed, and I did as well, I think everyone watching did, stocks sold off and fell, but also uncharacteristically, the 10-year, the yield fell, meaning that, the yield
rose,
went up, meaning that people were selling. So they're selling both bonds and stocks at the same time. And usually those are the other way around. So maybe we're seeing the beginning of the government losing control of the bond market. Maybe it's the beginnings of the hintings of a liquidity crisis. And what you've noticed is over the last 50 years, government's response to times that we may be approaching is to lower interest rates, making money cheaper, and increasing liquidity. And the one commonality of where we can park our money in the meantime, and what commodity does quite well during those times, is gold. You also mentioned, and this isn't something I had thought of, but possibly diversifying your cash position a little bit into playing a little currency diversity. I hadn't thought of that. And because of these increasing risks in the sector, your timing of Battle Bank should work out quite well. Does that about sum it?
Yeah, I think it will. I think it does. I think it does sum it up. I just like, particularly the members of the Rural Classroom, but everybody watching, to try in every circumstance, particularly when you're afraid, not to feel, but rather to think. Think about the likely outcome of the situation that you're in. Think about what your investments might be worth, what might cause them to be worth. Think about the distress that others are feeling in the market and what their likely reactions will be. I guarantee they'll be irrational. And while it's unfortunate, there may be opportunity for you in their irrationality.
Okay. What other currencies would you be looking at other than the dollar?
Well, for me, I live in several currencies. I'm not advocating buying Canadian dollars here, but if energy rebounds, and if the Prime Minister of Canada ever finds a business case for Canadian oil and gas, that currency might do well. I'm attracted to Singapore's currency. I'm still attracted to the Swiss franc, despite the fact that the Swiss are less Swiss than they used to be. But the truth is that really since 1982, with some strong periods of turbulence, the US dollar has been the strongest currency on the planet, and doing anything other than the US dollar, except for 2 or 3 periods of time in the middle part of the decade, 2000 to 2010, and briefly 1994, 1995, 1996. Aside from that, over 40 years, the place to be was in the dollar. You need to rethink that now. You really, truly need to rethink that now. We've gone from aggregate federal debt on balance sheet being a third of GDP to aggregate government debt being substantially larger than GDP. The circumstances that led to our total dominance have changed. And I'm not trying to say the US dollar isn't going to be the world's reserve currency. I'm just trying to say that if you, like myself, live partly outside the dollar, that you need to begin to consider whether or not you should diversify your savings. I'm not talking about speculating in currencies, by the way. I'm talking about denominating your liquidity in the currencies that you might need liquidity in. That's all I'm asking you to do. I'm also asking people who are listening to this to consider maintaining some of their liquidity in gold. We've cited before, Steve, in these interviews, the fact that the market share of precious metals and precious metals related equities relative to other asset classes in the United States is stupidly low. It's about 0.5%. The 4-decade mean market share is 2%. If the set of circumstances that we have described often in this show lead to increased interest in gold, my suspicion is that gold will at least revert to mean, if not exceed it. And if gold reverts to mean, that means that there's a 4-fold increase in demand for this asset class. Am I saying dump everything else and put all your cash in gold and gold stocks? Of course not. What I'm saying is increase your allocation. That's really easy because most people don't have one.
Okay. All righty. Okay, we're going to go to some questions here. And if you're watching this on any other outlet, on Twitter, on YouTube, any of the other ones, we're pulling the questions from the Rural Classroom Plus. So check below that post and there'll be a link into the Rural Classroom. And we would love to have you and submit your question to Rick. All right, we'll start out with Luce. How you doing, Luce? Got to meet her up in Vancouver and had dinner. That was a lot of fun. Rick, could you please comment on Silver Tiger metals?
I don't know enough about Silver Tiger to comment. The 2 or 3 times I've looked at it, it hasn't tempted me to part with my own money to acquire it. There are plenty of development stage or late exploration stage silver stocks for me to choose from. And for me personally, Silver Tiger wasn't among the top 5 or 6. And the consequence of that was that I wasn't tempted. I have not, I will admit, looked at it in the last 5 or 6 months.
Okay. Nicholas wants to know about Vale. Any thoughts on Vale at this point with the 15% dividend? Is it sustainable?
I don't think that the Vale dividend is sustainable. The stock sold off substantially. By the way, I sold mine when they had their tailings dam failure because I wanted to see what the ultimate liability around that failure was. It looks like it's $15 billion. Meanwhile, iron ore prices, which is Vale's principal product, are soft, and nickel prices, nickel and copper, well, nickel prices are soft, copper prices are not soft. Vale generates substantial free cash flow, but Vale also needs to begin to make a higher level of sustaining capital expenses, particularly around their iron ore operations in Brazil. So I don't believe that this dividend is sustainable.
Okay. Francis wants to know, says, love your comments on why silver is still stuck. So he's probably thinking it's kind of stuck in this $30 range. Any comments on that?
Yeah. I think the guy probably is asking me when. And the answer is, I have no earthly idea. But I can tell you that in the previous precious metals bull markets that I've lived through, the momentum is established by gold because the fear buyer always comes before the greed buyer. When the momentum is established by gold, and by the way, it's establishing itself pretty well, and the generalist investor becomes attracted to the precious metals narrative, when that happens, and I don't know when that will be, leadership changes from gold to silver. When that happens, you won't need some bald, fat crank named Rick Rule telling you what's happened. It will be completely obvious to you. When leadership changes, silver goes much further and much faster than gold. And the best performing financial asset class in the sector is certainly the higher quality silver stocks. I don't know when this will occur. One thing that I do want to add as an editorial comment, though, is that many people comment on the fact that gold is allegedly broken out to new all-time highs, while silver is less than the all-time highs. Remember, those are nominal highs. When they say gold is broken out to all-time highs, they're talking about all-time highs measured in 10 or 15 year ago dollars. The same with silver. The first time silver hit $50, if my memory serves me well, was in 1981. And think about the price of other things in 1981. Think about what that $50 would buy. 1981 was the era of $80 or $90 or $100,000 houses. It was the era of $15,000 cars. For silver to break out to all-time highs in real dollar terms, you're probably talking about $150 or $200 silver. By the way, this is not a forecast of $150 or $200 silver. But when you look at the upside in precious metals, I think people need to be more generous with their upside case. I don't think that they need, I think they need not to make those cases sacrosanct, carved in stone. But I do think that they need to talk about the possibility as opposed to a probability of precious metals prices that are not merely higher, but much, much higher.
Okay. Josh is asking, is Armitage Gold's Blackwater project a tier 1 deposit? And what ranking do you have them?
Artemis is not a tier 1 deposit, but it's been an amazing job of execution. Steve and Dean and his team have done a spectacular job. I see that as a very strong tier 2 deposit. I think that they will achieve so-called construction capacity pretty quickly. It'll take 6-9 months for them to shake the mine and the mill in. I would like to give them a higher grade as a consequence of their superb execution skills. The market, however, has noticed those execution skills, and the stock has performed extraordinarily well, which means that I have the stock as a weak 5, approaching a 6 from a valuation viewpoint.
Okay. Han is wanting to know about vanadium, and he's asking, you can probably guess the company. Largo, have you reviewed their latest earnings release of Largo from your past experience with great management team in a situation where the balance sheet is weak while vanadium price is still low? What should they do? Just thoughts on Largo.
Yeah, I was mistaken with Largo. I had a visit, 5 or 6 years ago with Robert Friedland, which is always interesting. And he talked to me about the technology bearing the vanadium redox battery. I was already attracted to vanadium, and I was already attracted to the fact that the price was low enough that producers weren't making any money. So I was attracted to Largo. I was attracted to a cheap way to play it that was generating free cash from operations at a period of low commodities prices. I was particularly attracted to their plan to start a product similar to the Sprott Physical Uranium Trust, where they would buy and warehouse vanadium, but rather than pay to store it, they would use it as a component in vanadium redox batteries and lease it to the user. The idea that you could store a commodity that was selling at a discount to the production cost, but rather than pay a storage fee and insurance, that you could receive a rent for it was attractive to me. So I bought the stock, and the plan didn't work. So I'm waiting. I still consider Largo to be cheap. I think the management team is superb. I like the asset. Steve, it's not going to be producing for my lifetime. It's going to be producing for your lifetime, which is much more attractive. Would I recommend it? It is not timely. And 5 years of extremely low vanadium prices have taken a toll on the balance sheet.
Yeah. Okay. Josh wants to know, what is Rick's thoughts and ranking for ATEX Resources?
I'm an ATEX shareholder. I have them as a 5. The only reason I don't have them as a 4, they've generated spectacular exploration results. I mean, just spectacular results. And of course, they're backed by Pierre Lassonde, who, in addition to being a personal friend of mine, is a hugely shrewd investor. Problem is the market's noticed. This thing, in the last 24 months has been on an absolute tear. There have been some exploration stocks where people haven't noticed the exploration success. ATEX is not one of them. I need to disclose to people that while I am a shareholder, I have sold enough of my stock that I've recouped the purchase price, meaning that I am what I call the point of no concern. I've sold enough stock that I have the rest of my stock for free.
Okay, maybe do a quick overview of the business model of Dundee and Strata, and then Adam wants to know, how do you value companies like this?
Well, Dundee and Strata are similar in that they're, in effect, financial holding companies. Strata, the principal asset at Strata right now, is a royalty on a strong tier 2 copper deposit in Africa, one that's being advanced to production by a good, solid mid-tier producer. I suspect that the royalty within Strata, and I've done some work on this, is worth in excess of the market cap of Strata. And you get their cash in their investment portfolio for free. Their investment portfolio, other than the royalty, hasn't done too well. Witness what's happened in the junior resource stocks for the last 3 years. these markets have taken no prisoner, and Strata has been a victim of that. Very recently, Strata has announced that they are going to acquire my former colleagues at Sprott Capital Partners, SCP. They're going to go into the mining and investment banking business. I think this is a spectacular event if it occurs. The business plan has been to offer up a specialty mining finance house that isn't just domiciled in one country. In other words, not a Canadian investment bank, not a European investment bank, not an Australian investment bank, but rather an investment bank who brings the best companies, irrespective of domicile, to the investors' attention, and the best investors, irrespective of domicile, to the industry. I also like the idea that an investment bank or a wealth manager would be public, so that it could be owned by its customers. My vision for Battle Bank has always been a bank that isn't owned by hedge funds, isn't owned by mutual funds, but is rather owned by depositors and borrowers. And I like the idea that Strata could end up being primarily owned by its customers and its employees. We're a long way from there. Stay tuned. No, I'm way long. The Dundee Corp is a bit of a different story. It's not a broker. It's not a money manager. It's a classic merchant bank. They utilize their very formidable due diligence skills. I would suggest that they're the best buy-side due diligence guys in Canada right now, to look for circumstances, particularly public companies, where they can become very large shareholders and bring more than money. Help these companies access capital, apply adult supervision, eventually monetizing the position and moving on. They had a recent pass with Reunion, something I joined them on, that was absolutely a spectacular pass. They joined the company what had less than 500,000 ounces of resource, helped the company grow past 5 million ounces of resource, and helped it merge into G Mining, making themselves tens of millions of dollars in the process. I would note, too, that every time I hear the word Dundee, I smile. The reason for that is that my first pass with Dundee happened with the current CEO's father, Ned Goodman, a mentor of mine. That mining merchant bank was spun out of International Corona when Homestake bought it. And if my memory serves me correctly, the people who owned Corona really wanted to own a mining company. They didn't want to own a financial services company. And so the stock sold off. I think its ascribed value was something like $1.50. The stock sold off to 62 cents. And we looked at it as a sum of the parts sort of thing and looked at Ned Goodman's expertise, managed to buy a lot of it for our clients. And that stock went, if my memory serves me correctly, from 62 cents or 63 cents, some number like that, to as high as $42. Now, you would be naive to believe that I bought all my stock at 62 cents and sold all my stock at $42. That didn't happen. I sold along the way. But the truth is that if you come into a mining bull market with a value-added investor, where rather than selling at a substantial holding company discount, you begin to sell at a premium as a consequence of the presumption of performance, you do very, very, very well. That's my same thesis for continuing to own Sprott. Although I'm no longer an employee, an officer, or a director, I am the largest shareholder. because I believe in an upcoming precious metals bull market that rather than people being bored of gold, people will look at the Sprott, will look at Sprott, they'll see the Sprott franchise and think of Sprott as a brand name for gold. At the same time, as the appreciation for precious metals assets increases, the assets under management at Sprott and hence their management fees should increase much more quickly than their fixed costs. So in all three of these circumstances, I'm looking at them as leveraged plays on a natural resource bull market.
Okay, so valuing strata would be basically looking at the royalty and
yeah, you need to do two things. Looking at strata, you need to look at the potential operating earnings from the investment bank. This year is a private firm, and last year is a private firm. They've done extraordinarily well, probably better than we can count on them doing going forward. But you also need to look at the sum of the parts. You need to say the investment portfolio is worth X, the royalty is worth Y, and the book value of the broker dealer is worth Z, or if you're Canadian, Z. And then you need to look at the Z component and say, separate and apart from tangible book, what can this thing earn over the 5-year time frame? So you need to look at the sum of the parts. In the case of Dundee, it's much more the sum of the parts. Yes, I think they deserve a premium because I think that their business plan is repeatable. And you get a management team that's taken 30 years to assemble, and over time you pay a premium for that. But you're going to value it, or rather the market's going to value it, on a sum of the parts basis. Dundee is selling, even after the stock has done fairly well, at, from my point of view, a 35 or 40% discount to the value of the sum of the parts. In the case of Sprott, it isn't a sum of the parts thing. This is a pure earnings play. Capital light business, so you don't have to worry about tangible book too much. You think about the leverage that you're going to get from the increase in assets under management and the increase in the management fee relative to the, we hope, smaller increase in fixed and variable costs. If the last 2 years are any example, the next 5 years are going to be an awful lot of fun. Understand that if, let's say, a product like Sprott Physical Uranium, it's a low fee product, a 35 or 40% product. But other than marketing, the only thing that they do is send KPMG or some auditor to a uranium storage facility and go 1 drum, 2 drum, 3 drum, 4 drum, open up a couple drums and make sure that what's in them is uranium. Meaning that the margin that they get on that management fee is crazy. And if the assets under management, as they did with the physical uranium product, go from $600 million to $6 or $7 billion, those management fees increase in lockstep, but the fixed costs associated with generating those management fees don't.
Yeah. It doesn't take much effort to count 10 times the amount of drums, but you get a lot more money for doing it.
And, you know, people don't understand what Sprott's been able to do. If my memory serves me well, when I joined the company, they had about $4 billion in total AUM. They're crowding 40 now.
First world problems. Okay, Gene wants to know, Rick, people say uranium is hated. Everyone with a following is bullish. It's not hated. What
Well, I think that's an interesting question. I think if you talk to people or you follow people like myself who've been in the uranium business for 20 years, it isn't hated. We're bullish. But if you talk to the friends that uranium made in the last 5 years, the Johnny-come-latelys, it is truly hated. I remember when I was posting caution several years ago, saying that the price of the junior uranium companies had used up a lot of the value in the thesis. People jumped at me in various social media platforms and said, you know what, you're just too old, you've lost it. This bull market's intact, next up $200, stuff like that. That same group of people, when they didn't see $200, but rather they saw 60 when they were hoping for 80, now think the game is over. There are a whole range of social media influencers who never should have had influence, but do, who have turned from wildly bullish, stupidly bullish, to incredibly bearish. I'm delighted to see the back of them.
Makes a market. We got to buy them from somewhere.
Yeah.
Okay, Han wants to know, what's your ranking on Devon Energy and Ivanhoe Mines after the recent drop? Will Devon Energy benefit if other countries need to buy U.S. natural gas to balance their trade deficit?
Yeah, I was about to reduce Devon from a 4 to a 5 until the recent market turbulence repriced it lower. I'm delighted by that. You'll notice, Steve, that since you and I started talking about natural gas on your own channel, we talked about it at $1.20 per million BTU as being simply too cheap. And since then, in 18 months, the price has gone to what, 350, 360 per million BTU.
Yeah.
So some of the discount is out of it. But the truth is that same BTU still sells in Rotterdam or Shanghai for $9 or $10. There's an enormous arbitrage between US and particularly Canadian natural gas and natural gas around the world. That arbitrage is doing a couple things. One, it's stimulating an awful lot of infrastructure construction, gas gathering, gas storage, gas pipeline, gas liquefaction. It's also leading to a bunch of onshoring, Mr. Trump notwithstanding. European manufacturers who are tired of paying $9 or $10 per million BTU are moving their production facilities, particularly from Germany, to the United States and using gas. You'll recall, Steve, a slogan, the cure for low prices is low prices. Well, the market's working. Natural gas is responding. Does it have more to go? Absolutely. Are there names that are more leveraged? Absolutely, too. I don't want the most leverage. I want the most leverage with the least risk. And there you're looking at names like Devon and Equitable. And I'm sorry, the second company you asked me about?
Ivanhoe Mines.
Ivanhoe Mines. I have lowered Ivanhoe from a 4 to a 5 because the stock has performed so well. But the truth is that there's a lot of growth to come. They will very soon be commissioning a smelter, meaning that rather than shipping concentrate via truck 1,500 miles and having that concentrate transshipped to smelters elsewhere, they're going to smelt it on site. They're going to sell copper rather than concentrate.
Yeah.
And rather than having to rely on a shaky Congolese grid supplemented by diesel fuel that they've had to truck in for 1,000 miles, they are increasingly able to supply their operation with energy from a hydroelectric facility 280 kilometers away that they refurbished, which is to say their energy costs are becoming more stable while they're becoming lower. At the same time, they're going to be able to beneficiate their own copper. On top of that, they're bringing into production Kipushi, the world's single highest grade zinc mine. And if that weren't enough, they will, a year or a year and a half from now, commence production at the Flat Reef, which will be the world's largest and perhaps one of the lowest cost platinum and palladium producers in the world. So there's a lot to like about Ivanhoe going forward. What might you dislike? Well, at the time that I first recommended it, below 65 Canadian cents, you'll recall that it had 90 cents a share cash in it, meaning that you got all the other rest of the assets for free. It had a market capitalization, if my memory serves me well, of $300 million. That market capitalization now is in the billions, which means that some of its charms have become apparent to the market. It's no longer as cheap. Now you have to pay for the upside rather than getting it for free. You also have to stomach very real political risk in South Africa and even more real political risk in Congo.
Okay. Political risk. Z-Sold says, hello, good people. What is your opinion, Rick, on Patriot Battery Metals' recent cesium discovery?
I sold my Patriot Battery Metals. I think that theme is, relative to other resource themes, overpriced. And I am always terrified of very small markets. People talk to me about scandium or indium or gallium or germanium or most of those things that end with IUM. The truth is those markets are so small that new fabrication demand can triple them while new supply can cause them to fall by 2/3. The consequence of that is that I prefer markets like copper, iron, coal, gold, and I try not to pay any attention to elements ending with IUM that I have trouble spelling.
Okay. Okay. Alan wants to know, he says, Rick, recently you said you no longer own Seabridge, but you just interviewed Rudy Frank. Are you back in the game?
Yeah, Seabridge fell substantially in price, and I reviewed the reasons why I owned it, and I reviewed the reasons why I sold it. I sold it because it doubled, and it was leveraged to gold, and I had a lot of gold. Neglecting to pay attention in my mind to the increased leverage that you have in Seabridge as the gold price goes up, which is to say your margin in Seabridge at $2,000 gold may have been non-existent, but your margin at $3,000 gold suddenly becomes pretty interesting. And I'm a gold bug. There's 140 million ounces of gold there. And it might be that gold never gets beneficiated because it's going to take a lot of money to put it in production. The other thing is that I have been concerned about the tenor of that deposit, the permitting. But Seabridge is closing in on having spent $500 million on that deposit, including preliminary works. And I believe, although I do not know, that they're fairly close to an agreement with the Tahltan First Nation, which I think will lead to an acceptance by the province of British Columbia that will firm up their tenor. So the consequence of that is that I'm back in Seabridge as a speculator because of the leverage to gold and because of what I think will be improvements in their title.
Yeah, we pulled that up the other day when we did our charting session, and I overlaid it with gold and copper, and their copper deposit is enormous too, so it also tracks that.
Yeah, I think the market still reviews it as a gold stock.
Okay.
And I mean, in truth, I think what people need to understand about Seabridge is despite the very large mineral endowment, and despite relatively good infrastructure compared to 15 years ago, building this thing's probably going to be a $10 billion chore, which means Seabridge isn't going to do it. And if you are paying back the capital on a $10 billion chore, you're going to need the copper and you're going to need the gold and you're going to need the silver. You're going to need it all. And in addition to that, it would be very, very, very helpful if in that deposit there is another place like Brucejack, where there's enough ground preparation that the mineralizing fluids precipitated out in high enough quality and high enough quantity that there's a good starter deposit. If that occurs, you're off to the races. Remember that if you're, let's say you're Newmont, right?
Newmont owns Brucejack.
Yeah, but let's talk about them in general. Let's say if you're Newmont, yes, you have two operations in the area, Brucejack and Red Chris, but you're producing 5 or 6 million ounces a year. It's difficult to replace 5 or 6 million ounces a year. Yeah. And in order not to be in liquidation, you need a big resource base to start from. At a certain gold price, this thing becomes irresistible because a company could, in one fell swoop, take care of their depletion challenge for a couple decades.
Yeah. Yeah. Okay. Well, Nations Royalty would be stoked on that.
Nations Royalty would be stoked. And, you know, Nations Royalty is an interesting play generally. They ascribe more value probably to the KSM deposit than you can do due to the uncertainty of the start date.
Yeah.
What's interesting to me about Nations Royalty is that whole concept. The idea that you will have an indigenous owned or at least controlled public royalty company that can provide consulting to various indigenous bands throughout North America to help them beneficiate their own resource endowments, where increasingly the nation's royalty personnel that they talk to are indigenous people who they feel comfortable talking to, rather than some fat old white guy like me. In particular, I'm attracted to their young business development guy, Cody Penner, who I've attempted to mentor for 10 years. He's a really, truly top quality human being.
Okay, we got about 10 minutes left. So anyone watching on any other channels, whether it's Twitter or LinkedIn or wherever you're watching, follow the link down below to the Rural Classroom, and that's where we're pulling the questions from. And you can submit your question for Rick there. Zahara has a question on oil and gas. So she's saying, from a 5-year perspective, how do you think about the demand destruction in oil and gas due to recession versus the supply shortfall that would occur in a normalized demand environment?
The shortfall is going to happen.
Okay.
Because the industry is, according to the International Energy Agency, deferring in excess of $1 billion a day of sustaining capital investments. And in a capital intensive business, if you don't make the sustaining capital investments, you don't sustain the production. There are a lot of public companies in North America that are partially funding their very high dividends by not making sustaining capital investments. They're cannibalizing their business. And most state-owned companies around the world, PDVSA, Pemex, companies like that, are doing precisely the same thing. So there's zero doubt in my mind that we're facing production shortfalls. The second thing with regards to production shortfalls is more speculative, but there is a suggestion that the incredible production increases that we've seen primarily from the Permian Basin in the US are about over. There is a suggestion that at current commodity prices, the number of grade A undrilled locations that they have is down to about 15% of total locations. A comparable number in the Western Canadian Sedimentary Basin would be 50 or 60% undrilled grade A. And further, there are credible suggestions. I haven't studied this in enough detail to verify them, that there's an increasing shortage of saltwater disposal capacity in the Permian Basin. When you produce oil and gas in the Permian Basin, you produce a lot of salt water from it. You have to make that stuff go somewhere. The incredible increases in production has meant that the saltwater production has increased to the extent that it's increasingly difficult for us to find a place to put it. And that problem will need to be dealt with. If you combine the reduced sustaining capital investments by oil and gas companies around the world with a potential shortfall in the increase in production with the Permian Basin, you have what I would suggest are inevitable production declines over 5 years. You can have a supply decline if you have a demand decline and prices don't move. Prices are set on the margin between supply and demand. And I think what you're seeing right now in energy markets is the response to a very real global economic slowdown that's occurring in real time right now. At the same time as you are seeing global interests afraid of the impact of tariffs and a trade war. If this develops into a full-fledged recession, what you will see is the oil and gas thesis delayed for 2 or 3 years, but you will not see it derailed. Make no mistake, the oil and gas industry is priced as though peak oil demand occurs in 2030 or 2032, which is to say that the investors of the world, for whatever reason, are listening to those energy physicists like Angela Merkel and Greta Thunberg. My own suspicion is that peak oil demand occurs in 2060 or 2065, which means on a net present value basis, the industry is probably selling at half what it's worth.
Okay. So have you followed OPEC recently? It looks like what are their outputs? Could that have an effect on it?
Yeah, OPEC is successful at raising prices when the price wants to go up.
Okay.
I really think it's a place where oil ministers get to hang out in more permissive countries than the countries that they live in. When it's convenient, which is very rarely, the companies stick to their quota. And when they don't, they try to make other countries stick to their quota while they exceed theirs.
Okay.
I think the OPEC guys are really politicians. And my opinion of politicians.
Yeah. Okay. All right. So even if this happens, the oil thesis could be delayed by a couple of years, but it's not off at all.
I mean, the truth is that a lot of investors look at OPEC's intention. And so OPEC's published intention can firm oil quotes for 6 weeks and can cause the price of Exxon to go up by 5%. That's just of no interest to me. I own Exxon because of the dividend, because I think 5 years from now, it might be 200 or 300% higher. These 5% moves in 6 weeks, they're boring to me.
Yeah, don't care. Okay. All right. Francis, so I'm interested in this one too. I just had a limit order for this one hit at $1.50. UROY, Uranium Royalty Corporation, ranking, thoughts?
I have UROY as a 4. I had it as a 6 some time ago because the stock had done so well. Remembering that most of the assets were cash, it was like paying $1 for 30 cents worth of cash. That wasn't much fun. They've deployed a lot of the cash, and the price is really cratered. I think people who are speculators who have a reasonably long time frame, by reasonably long time frame, I mean 3 to 4, 5 year time frame, likely have a triple from here. Triples are good. And by the way, that's at fairly constant uranium prices. That triple number has to do with people putting more pounds into production because of the lower cost of capital afforded by term contracts. My triple isn't talking about the uranium price, the spot price going from, $60 to $90 or $100. I'm perfectly comfortable with the term price at $80, given that development stage projects could be financed at this price.
Okay. And Patrick wants to know, hi, does Rick have any thoughts on the Silver Corp team and their ability to build El Domo?
I don't know enough about El Domo to comment. The Silver Corp team is a superb team. They've delivered for shareholders twice, and they've delivered full cycle. I mean, taking what was effectively a grassroots, maybe a brownfield silver deposit to production twice. Luck favors the trained observer. What these guys are good at is discovering and developing silver deposits in Mexico. And what they're trying to do now is develop a silver deposit in Mexico. High quality people. Whether this deposit will work is a different story. I don't know it well enough to comment.
Okay, but experience related to the task at hand?
Great folks.
Okay.
Great. By the way, they realize their successes too. They when they get paid a full price, they cash out, and they cash out at the same price as everybody else. They don't trade their own stock. You don't see these guys making themselves paper at 25 cents and selling the paper at 75 cents. You see themselves making a bunch of paper, working very hard to backfill value, occasionally trading their options because they don't pay themselves much. They live on the options, and then selling all at once the same time that you do. In other words, their interests are aligned.
Yes. Okay, we are getting close to the hour here. We've got the Rule Symposium coming up. I am really excited about this one, Rick.
I really want to talk about this. We're running well ahead of last year in terms of attendance.
Oh, good.
And we should be. This year's going to be absolutely spectacular. With all the talk of debt and deficits in the Department of Government Efficiency, we're bringing in David Stockman. David Stockman, for those of you who don't know, was the guy who tried to do this before. He was the director of the Office of Management and Budget under Reagan. And he talked about the political derailment of the Reagan Revolution to reduce the size of government. Very recently, he's written a new book about how you cut $2 trillion out of the U.S. budget deficit. What I want to talk about that we do at the symposium is something that nobody else does. When we have our big picture thinkers, they're not journalists. They are people who were participants, players in the task at hand. David Stockman talks about the budget, and he was the director of the Office of Management and Budget. He talks about the political process because he was a senator. You know what I'm saying? I mean, in a biblical sense, he's from the belly of the beast. We have Nomi Prinz talking about the structure of Wall Street, not as a journalist. She was a partner at Goldman Sachs. She was there. She saw it. She did it. We have Daniela Dina Martino Booth talking about the Fed because she was a researcher at the Dallas Fed. We have Jim Rickards talking about the financial structure of Wall Street because he was general counsel at Long-Term Capital Management, whose failure almost brought down Wall Street. It's important that you pay attention, particularly in tumultuous times like this, with the big picture, but a big picture that doesn't come from CNBC or CBC, from a bunch of journalists who are freshly minted from some quasi-socialist institution. It's important that your big picture points of view be shaped by people who were from the belly of the beast, who talk about the institutions from an insider's point of view. Once we're done with that, we introduce you to portfolio managers and analysts who are from the natural resources business, who have been there for 30 years, through thick and thin. Not somebody who failed in technology and failed in consumer durables and parachuted in lately, but again, people from the belly of the beast. This conference is from the belly of the beast. It's gone on for 30 years. Unlike any other investment conference in the world, every exhibitor at our conference has been vetted. They are owned in accounts owned and managed by the conference sponsors. No guarantee, Steve, as you know, that because I own a stock, it goes up, but there is a guarantee that I have vetted the company if I bought it, believe me. And all of those factors, the fact that the conference has gone on for 30 years and hence has very high quality attendees, the fact that the big picture thinkers are from the belly of the beast, the fact that the analysts are from the belly of the beasts, the fact that we deliver up to you the living legends who built multi-billion-dollar natural resource companies from scratch, allows me to say to any potential attendee that we do something that no other investment conference in the world does. We have a 100% guarantee. If you attend the conference live in Boca Raton or live stream in the comfort and convenience of your own home or office, if you don't feel that we've given you your money's worth, simply tell us. We'll give you your money back. We've had this guarantee in place for 30 years. We've had to refund less than 0.1% of the money that we've charged. That notwithstanding, the financial risk of the conference is all mine, a money-back guarantee. I want to see everybody at the Rural Symposium, and I want everybody to pay particular attention to David Stockman. This is important to your life. It's important to your portfolio. It's particularly important to precious metals investors and speculators.
Yes, sir. I look forward to it. Last year was the first time that I went, and I already got my tickets and everything for this year. I'm super excited, so really looking forward to it as well. We have some upcoming events in the Rural Classroom. We have Brian London coming up next week, and then same bad time, same bad channel with you, Rick. We got a live Q&A next Thursday as well. Thank you very much. Any final thoughts, Rick?
Well, simply keep in mind the slogan for today's call: panic or pounce. The choice is yours. Just like we used to say contrarian or victim, the choice is yours. Maybe I said the same thing twice. Think about that. Think about the lessons in the Rural Classroom. Learn that unless you have determined value, price is of no concern whatsoever.
Yeah, I did some research on the charts, and when you have a massive upswing like we did yesterday, it's usually not the bottom. It actually goes a little bit lower after that. But if you fast forward a year time, it was always a good deal. So that bottom just before it spikes. So I think we're getting close. But anyways, Rick, thank you very much. That was a lot of fun. I look forward to the next one.
Thank you for your contributions to the channel, sir.
Yes, and thank you for tuning in. And we will catch you next time in the Rural Classroom and the Rural Classroom Plus. You have yourself a great rest of the day.